Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Thursday morning, we're coming to you live, as always, from the CNBC-TV18 Motilal Oswal studios. It's a recovery and repair over the last couple of days, and today seems like it's set up to be a good day once again. I'm Prashant, with me, my colleague Surabhi and Nigel. Guys, hi, good morning.
Hi, guys. Morning.
Good morning. I mean, it's a good-looking screen, better-looking cues. It's been a while, right? So let's hope we could build onto that.
Been a while where we can definitely firmly say right at the word go at 8 o'clock in the morning that I think it's going to be a good day. So let's see. Is the gift nifty telling us something else? I don't know, but we'll have that coming up in just a bit. Now, let's just take it from the beginning because there is a fair bit to cover. President Trump granted the first tariff exemption that came in last night. And there were indications of it through the course of Asia session. Actually, there were indications of it in the prior US session. So 1 month exemption for autos in Canada, Mexico. And of course, this basically essentially opens up the door. The markets are hopeful that other tariffs can be negotiated as well. If this can be negotiated, why not others? And I think the markets, by the way, equities in the US did not immediately react to this, but then eventually they did. The Nasdaq ended about 1.46% higher. The S&P was higher as well, about 1% plus. The dollar is the bigger story. The dollar index, the broader dollar, continues to fall, and it fell another 1% plus to about 104.3. And in the last three sessions, the dollar is down 3% in three sessions. That is humongous. That's a very large fall from 107.5 to 104.3 last night. I mean, it's one of the fastest, sort of quickest climb downs we've seen in the dollar at any point. I think you had to go back some distance for this kind of price action. Oil is the other one. I mean, yields 5 down, 5 up, so I'm not spending time there. But oil prices down 2.4%, and we're under $70 a barrel as far as Brent is concerned. I think WTI is about 65. So we are basically in the 60s handle. And for a big oil importer like India, this is definitely very, very good news in that sense. So, you know, we'll, of course, with our research team, talk about which stocks and sectors, etc. But some are, of course, obvious. And we saw a glimpse of that even yesterday. Now, US ISM Services Index improved 53.5 to 52.5 in the month of February, despite tariff uncertainties. Remember, I always say services is the more sticky part of the economy anyway. And the fact that that part in the US is holding strong, it kind of runs in the face of some of the other high-frequency data, which we've seen, which has actually come in a little weak. The other big story, of course, is out of Europe. European bond yields surged 25 to 30 basis points yesterday. It's the biggest one-day move we've seen since 1990. German bonds went up about 25 basis points. And, of course, the differential between, bonds and bonds in the US, that sort of, climbed and massively to about 27, 30 odd basis points or so. Markets essentially saw Germany's whatever it takes moment last night. Remember, we've recently had elections in Germany. And the campaign, etc., from people who won, who are in power, CDU and other parties, has been that, we're going to stay the course. Maybe we will spend a little bit more, but nothing dramatic, nothing drastic. But what they did yesterday was a U-turn. It's a massive U-turn. So they're saying that they're going to spend big on defense. They're going to spend big on infrastructure, not going into details, maybe a little later. It's a massive U-turn, as I said, on fiscal, defense and security policy as well. And, the ironic thing is the German head of state yesterday used what Mario Draghi used, the phrase Mario Draghi used 10 years ago. He said, whatever it takes. Back then, the highest the highest German court actually had stepped in and said, well, they ruled against what Draghi was trying to do for the EU. Of course, it was eventually overturned, but it's ironic that you got the head of German state now essentially coming in and saying whatever it takes. That phrase, I think, is what really took the markets by surprise. By the way, today, European leaders are meeting in Brussels today. Zelensky is expected to attend. And of course, this will tie in with whatever we see on the Ukraine front, whether we'll see some sort of peace announcement, etc. Europeans seem like they want to fight. US, of course, is forcing Ukraine to come to the table and negotiate and end the conflict. Just to sort of tie in the levels, etc., Nifty's, of course, snapped its 10-day losing streak yesterday. And large caps did well, etc. There was one sector which did not do well was financials. Financials is a space underperformed yesterday. The RBI, after market hours, announced more liquidity infusion, more details in a bit, positive for that space, for financials. But I think for the broader market as well, if it is positive for financials, the Nifty, in terms of levels, ended above the 40-hourly exponential average, the level we put out yesterday, just marginally, 20 points above that level. The next targets here are, I mean, you basically, you got to track the fall and then the levels where the Nifty halted for a while. The lows, 22,500 and then 22,715 are the next two levels on the way up for the Nifty. Nifty Bank also closed above the 40-hourly exponential average. It needs to get past the 48,550 level. And of course, I mean, the recent lows should not come into view if this has got to play out from here on. GIFT Nifty will give you a sense of how we are likely to start. You know, leverage in the system is low. There are shots built into the system. Positioning is pretty clean, and you got this positive macro setup. Yesterday, weaker hands got out. The question is, today, will stronger hands buy the market? And I think at the margin, perhaps the answer is definitely yes. Nigel.
Well, it's been a while since we have had such positive cues, right? The Dow ends higher. The ADRs as well were higher overnight if you look at the banking names that trade. And, you know, this sort of positivity, after a while, we're waking up to. And as you said, the RBI, well, they are managing the liquidity front as well. Let's get to the top cues, though. Yesterday, the Nifty broke the 10-session losing streak. Great, right? Because that's the first time in history, actually, that we saw the Nifty ending down for close to around 10 straight sessions. And, you know, we have some data points coming in from Samco. They say that since 2002 onwards, the Nifty has been on an 8-session or more losing streak for close to around 9 times. But 6 out of the 9 times, 1 month down the line, we're actually higher. And we're higher by close to around 2.6% on an average. That's the data point that's coming in there. So we've had 10 sessions on a losing streak. In February, 90% of the days, the Nifty was in the red. That's 18 out of 20. So some kind of positivity, that's good to hear. Let's see a few more data points then. The dollar index at multi-month lows, Brent crude prices below its 52-week lows, and you have the US yields as well that are more or less steady. In the last few trading sessions, the FIs, yes, they're net selling, but the net sell number has come down from sub 5,000 crores to sub 4,000 crores to sub 3,000 crores. With this sort of a backdrop, today I'd like to see a number sub that 2,000 crores, and the FI selling needs to get a little bit lower. That's what will help our markets. In yesterday's trading session, it was a good one because we ended virtually at the high point of the day, and there was about a short covering that we saw both on the Nifty as well as on the Nifty Bank. The open interest was low. And just take a look at the net short positions of the FIs. They're well and truly net short on the index, but it's come down marginally. From around 85%, it's come down to sub 83% or thereabouts. So there's a lot of shorts in the system, but at least some tapering down of shorts is what we've seen both in percentage as well as in absolute contracts. On stock futures, this is interesting, right? Because they have been net long on stock futures, but now on the stock future side as well, the shorts that are on the system, for the last 2 trading sessions, they've actually closed out close to around 26 to around 27,000 contracts. That's another positive sign as well. So though the FIs are selling in the cash market, the futures data could suggest that they could be getting trapped on the wrong side. We'll see how that plays out. The margin trading book. You know, just a few weeks ago, that number was close to around 80,000 crores. That number has come down to around 69,000 crores or thereabouts. That's telling you that the leverage in the system is relatively lower, and you like this number to stay at a lower level. Remember, this is subject to change, and we get it with a bit of a lag, but that's another important data point. The leverage in the system seems like bulk of that margins, margin trading has got cleared out of the system, which is good news. Today is the Nifty expiry. Remember, it's Thursday, so we'll have a weekly expiry that will play out. The 2 strikes that are most active, they come up for you on the screen. And just punching in the premiums and looking at the technicals, the important mark to hold out. For today, the 22,150, that should not hold out. If it's going to be a good trading session, we should get past the 22,450 to around the 22,500 mark. This is where there is some resistance. Sectors that I'm looking at, 2 of them. The dollar index has cooled off. The metal index could be in focus, because you have LME prices that are moved up. So that's possibly the sector of the day, though it's pulled back. And OMCs I'm going to be looking at because remember, they have good amount of dividend yield in there. Valuation-wise, there is some support. Crude oil prices have cooled off, which is good for them. Marketing margins, I was looking at a DAM note. They are saying that they're working with marketing margins of around 4.5 to 5 rupees per litre for the next year. And as of now, it's more than 8 rupees. So these stocks that have rallied in the last couple of sessions, they could be in for more. We'll keep an eye on them.
Okay, all right, great. We absolutely will. And it's a largely good backdrop, green backdrop across Asia as well, because most of those markets are trading higher. And the Japanese market is, rejoicing the fact that at least for some automakers, for at least a while, there will be some relief with respect to those US tariffs. So, and the Hong Kong market was so strong yesterday as well because of the kind of GDP growth targets, the deficit, increase targets that China had put out. And more of that is continuing on Hong Kong this morning. By the way, in just a bit, so everything is positive, except one new development that our colleague Parikshit is going to talk about very, very soon. You remember, we told you this on Monday morning that the US Commerce Minister, Mr. Piyush Goyal, has been spending a lot of hard days and nights with parlays in the US. He's been in the US all week to try and get this trade deal going between the US and India. Guess what Parikshit's sources are telling him? That the US perhaps is not in much of a mood to relent. So that's a teaser. He's going to come in and talk more about it. And of course, you would have heard a lot of the reports about Tesla rolling into India. And there's a showroom being set up in BKC right here in Mumbai. The question is whether Tesla is going to come in at zero duty. Will Tesla be allowed to come and sell their cars at zero duty? That's something that we really need to look out for. But reports are indicating, that BKC is going to be the place from where Nigel can buy his first Tesla. Okay, I think we'll debate that as we go along. Yeah.
Most of the money is going in the SIP book. I'm man of my word.
He's a sensible, family man. Okay. All right, let's move on then to the equity calls of the morning. We've got Mahesh Nadulkar of Jefferies saying that India's underperformance relative to EMs by 21 percentage points in September 24 has brought its relative valuations against the MSCI emerging market to the 10-year average. Historically, he says, from such levels, Indian markets had bounced both in relative and absolute terms. He adds that with the dollar index down 4% from the peak, FPI flows might turn. He says their FPI ownership tracker indicates that India's positioning by EM funds is at a decadal low. He says near-term positives such as economic uptake, liquidity easing may lead to a near-term bounce.
All right, Samir and Chakrabarti of Citi says that they estimate that durable liquidity remained in slight deficit on February 21st, and in line with their expectation, the RBI has announced further 1.8 trillion rupee liquidity infusion. He says the overall quantum is higher than their estimate, as the RBI might be aiming to replace some of the 1.8 lakh crore outstanding VRR that are maturing in early April. He estimates that durable liquidity would now move towards 1.2 lakh crore surplus by end of March. He adds, including outstanding VRRs, liquidity surplus could be near 3 trillion rupees now. A dovish MPC minutes, downside risk to growth from trade wars, likely below 4% February CPI, front-loaded macro-prudential easing and liquidity infusion support their view of at least 225 basis point rate cuts in April and then June.
All right, well, let's discuss the global backdrop and the road ahead for India with Jeffrey Dennis, independent emerging markets commentator. Mr. Dennis, great to have you on. Good morning to you. So now we're getting some sense of partial relief, some hope that there's going to be a rollback in those tariffs, and there's still some room for negotiations. That's given global equities a sigh of relief. But what do you think lies ahead? And specifically, I mean, if we talk about a market like India, which has been reeling under these FPI outflows, how is the overall backdrop looking?
Well, I wish I knew, frankly, because, of course, the situation with tariffs is extraordinarily volatile. And we enter this week, and there's a lot more aggressive tariff action apparently coming with respect to China, with respect to Canada and Mexico and China. Now we're getting some relief apparently on that for a month on the automakers. It just goes round and round in circles. And I think this is really, really bad news, actually, for the US economy, which maybe we can talk about in a minute. And this is what's been driving bond yields lower. Now, if you look at where we stand here, is I think Trump is still obsessed with the idea that he wants to put tariffs on many countries and many products. And so I don't think in any sense we're going to get major relief from here, except we just don't know. Now, how does India stack up with all of this, as you've asked me that? Well, my call this year has not gone well. I thought India would perform better than it's done. China, of course, is led the way for a number of reasons, not least perception of undervaluation, perception of decent growth. 5%, of course, is the new government's forecast, etc. And, of course, the new AI tool coming out of China. But at the end of the day, I still think money will come out of China, go back to India, because the India story remains, I think, better long term. And now you've seen a tremendous move in relative valuations between the two. Now, as all of this goes on, China is a target of Trump and tariffs. India, I don't think is. It could become one, but it's not at this point. The growth story is much better. And of course, you mentioned a few moments ago, there's been a very sharp drop in oil prices in recent days, and that's very good for India as well. So I'm sticking to my medium-term bullish view on India.
Jeffrey, a dollar has also come off very sharply. That's positive for EM flows. 3% in 3 days, the broader dollar. And of course, oil is there. And so things seem to be constructive here. At least the backdrop is quite constructive. Just a quick view on what we saw in Europe, Jeffrey. It's a big sea change. I don't want to exaggerate, but it almost looks like Europe is going to start to rearm itself. Of course, they're going to spend on other stuff, roads and bridges and energy plants, etc., but also defense. And this is a change after, I think this is a seminal change post-World War II.
I think it's very, very important, and I think you've hit the nail on the head here. There are two things driving the dollar lower. First of all, the US economic data is terrible, frankly, and there is an increased risk of recession. Let's leave that aside for now. What's going on in Europe is very, very important, particularly in Germany, setting aside money for increased infrastructure spending, for increased defense spending, and in particular, an agreement between the CDU and the SPD in Germany to essentially ease the debt brake, so-called, the limit on how big the debt increase could be. That is very, very, very important because, of course, Germany for so long was the sort of anchor of Europe, the example of fiscal rectitude, inflationary control. And now they've thrown a lot of money at this, which I think they need to do. And I think it's been also very interesting how politically so many people in Europe have rallied around Ukraine since this extraordinary argument between Zelensky and Trump and Vance in the White House less than a week ago. So now you're talking about more defense spending, countries cooperating, France, the UK, Germany, and you're talking about security guarantees. This is a very, very big change. And I think this has played a tremendously important role in driving the euro higher as well. But don't forget, the real signs of weak US growth are playing a role also.
All right. Hi, Jeff. Good morning. Good to see you. And Jeff, since we're talking about Trump, what do you think the bigger focus for him is going to be? When he won the election for the second term, everyone thought Trump's going to be good for equity markets, particularly the US markets out there. Now he's in a bit of a catch-22 situation, right? Trump's or the markets? What do you think is going to be his bigger focus?
Well, the word over here is that what he's going to focus on now is bond yields because they're falling. And when Scott Bessent, the new Treasury Secretary, talks about we're going to get interest rates down, apparently now everybody is told we should be focusing on long rates coming down, not short rates. The Fed is in no position right now to be able to reduce interest rates unless this economic data gets a lot weaker. I think it's very interesting that with the equity market being so soft so far this year, the US market is in negative territory now for the year. Trump just doesn't talk about it, which I think is interesting. But I think we may be close to a little bit of a breaking point here in the sense that the economy is very soft. I don't know if you've seen this.
Yes.
I'm sure you have. The Atlanta Fed forecast for Q1 is minus 2.5%. That's a bad sign. And also, of course, the sheer uncertainty over tariffs is terrible for consumer confidence, terrible for business confidence, terrible for investor confidence. So I think he's saddled himself now with a very soft equity environment. Globally, okay, things are looking better, helped by the lower dollar. But frankly, the US equity outlook right now doesn't look good because of all the mistakes he's making and all the volatility that he's creating with his tariff policy.
So one would only hope that perhaps, he listens, because he did yesterday. He held that call with US automakers. He called up the Ford CEO. And that's how some of the rollbacks on the components happened, or some partial sort of relief that kind of came about. And Nigel, you were saying something.
So, Dennis, Trump's tariffs will be more a negotiating tool, is what we're getting to it. Do you think that's going to be the way it plays out?
It seems to be the case, although some of the things he would indicate suggest that it's more than just a negotiating tool. And I don't think net, when we look back in a year's time, we'll find that tariffs are lower or the same. they're going to be higher. We just don't know by how much. And he's going to look for deals to possibly take them off for a period of time, put them back.
Right.
The problem with tariffs is that they raise inflation. This economy can't really deal right now with higher inflation. The Fed would not be able to reduce rates. And I think it's this dilemma, maybe a hint of stagflation, that is really pulling the US equity market down and the dollar down. And frankly, Trump policies are really pretty awful for the equity market in the US right now. And we've got to see if that's going to change.
Okay, all right. I think there was some acknowledgement yesterday in that speech, State of the Union, that near term we should bear some pain. And I thought that was interesting. Thank you very much, Jeffrey. It's always great to speak with you. We'll take a quick commercial break here. Lots of stock-specific action. Our research team joins in with exactly that in just a bit. Top 10 segment coming up. We're looking at Asian Paints, HPCL, BPCL, IOC, SBI, HDFC Bank, ICICI Bank, Bajaj Finance, Shriram Finance, all green. And what's on the red side? I think there is ONGC. Oil prices have dropped. That's a producer. That's one name out of the 10. Our research team joins us in just a bit.
Welcome back. You're with us on Bazaar Morning Call, and as we've been telling you, the picture across Asia is largely green. Most markets are holding up quite well. The Japanese market, of course, the Hong Kong markets as well, looking quite okay. So let's quickly pull up the implied open to see what that could translate into for us, given yesterday's big surge. We'll just get the GIFT Nifty and the implied open up as well. There you go, about 42 points higher is the expectation. Now, what about individual stocks? Well, our CNBC-TV18 list of top stocks to watch is ready with the whole team on standby. So let's straight away, go to it. We have Lata joining in to talk about the RBI action yesterday, further measures to boost liquidity. This includes more swaps as well, more open market operations. Let's go across to Lata for more details and the impact. Lata.
Yeah, that's right. 10 billion of buy-sell swaps that they're going to do. And that's on March 24th. And then they're going to buy 1 lakh crore of bonds. Now, we have to remember that the RBI intervened at many times in November, December, January, but did not actually sell the dollars. They did a sell and then did a buy-sell. So that sell is maturing now and they have to deliver the dollars. So some of it they're pushing forward. Already, if you remember, on February 28th, they did one $10 billion buy-sell swap and pushed that by 3 years. Now they're going to do yet another swap, buy-sell swap again, so that the dollars that they have to, sell to the market will have to go after 3 years, another 36 months. So 20 billion is not a problem. That has already been pushed back by 6 months with these steps. But we know from the RBI February bulletin that there is $80 billion of these open positions sitting as of February, and maybe it's a little more now. Now, the remaining dollars, when they come for maturity, the Reserve Bank may actually sell it from their reserves, because at the moment, the rupee seems to have turned the corner, primarily because the dollar appears to have clearly gone back to the pre-Trump days. The Trump trade seems to be over. And so now it'll be easy for Reserve Bank to take those, dollar deliveries. But more importantly, because of this transaction, this 10 billion buy-sell swap, which they have done 2 in a row, the cost of the forward dollar will fall very sharply. It's expected to fall by some 15 basis points from 6.33% to 6.2%. Now, what happens is a corporate that is looking at it, you're able to hedge the dollar so cheaply, they will go for ECBs. The expectation is that that will bridge the capital deficit. A lot of capital outflows have happened by FPIs. That will be bridged if you keep the forward rates low. Indian corporates will fill it up. That's the expectation. So even exporters, as they see the forward dollar falling, are likely to bring in their dollars from their external export foreign currency account. The other piece that they have done is this 1 lakh crore of bond purchases on 2 days, March 18th and March 24th. Now, there are some repos that are maturing, and there is the big advance tax outflow. So to cover the liquidity deficit during those days, by more durable liquidity, these 1 lakh crore of liquidity is given to the market. The bankers and the NBFCs will be thrilled. Immediately, you will see market rates going down. For instance, the 10-year yield will come down from about 6.73 to 6.68 or thereabouts, at least a 5 basis point fall. Cost of all shorter-term paper will come down. Good times for NBFCs. In a bit, if this liquidity continues, the banks will be able to pass on the deposit cut, which means the cost of their raw material deposits will fall. So very good news for banks and NBFCs.
All right, Lata, thanks a lot for that. The RBI's moves have been something that, has been really been very, very positive. And the new RBI governor, from the word go itself, it appears the greater focus is on growth and focusing on liquidity, which is good news from an economy and the stock market perspective. The other good news is that overnight, we had crude oil prices that have visited 52-week lows. Manisha joins us to tell us more on that front. Morning, Manisha.
Morning, well, yes, absolute sharp declines coming in for the crude oil prices. Near 3-year lows is where we're looking at the U.S. crude oil prices now trading at. So while the Brent has fallen below 69, WTI has seen a slip below $66 a barrel. You know, with the way the crude oil prices are, we are down 5% on week. We've declined by 7% in this year. And this is after 3% of a decline in crude oil prices in 2024. So crude has seen 2 years of declines, and 2025 is turning out to be a third straight year like that. Well, 3 factors to watch out for when it comes to crude. One is the U.S. inventories in crude, which have continued to increase. The other is the OPEC and allies, which will increase production from the month of April. So that tells you more supplies coming into the market. And third is really about the tariffs and the retaliatory tariffs, and the market's fearing that it will slow the global economic growth. It will weaken energy demand. So that sentiment really seems to be playing in as well, and is the reason you've seen nearly 5% of a cut already come in for the crude oil prices in last 5 trading sessions.
All right, Manisha, thank you very much for that. So that is oil prices in focus, and there's a big positive, big macro positive. So, just kind of highlighting the stocks here, and Asian Paints, HP, BP, IOC, SBI, HDFC Bank, ICICI Bank, Bajaj Finance, Shriram Finance, these are essentially all stocks which should open up in the green. The kind of sort of lift for all these stocks essentially is the underlying macros. And of course, ONGC is the one which perhaps starts on the other side. We'll connect with Deepan Mehta, with Elixir Equities, in just a bit. Stay with us. Fundamental stock talk coming up on the other side.
Welcome back. You're tuned in to Bazaar Morning Call. Well, the cues that we've got overnight are far more positive, and the gift nifty for starters is suggesting after yesterday's good close, we could see a 30-40 point bump up yet again this morning. Deepan Mehta of Elixir Equities joins us on the show. Hi Deepan, good morning and good to see you. Deepan, the big tailwind this morning is crude oil prices at a multi-year low, which is great news from a macro perspective and for select stocks as well. So let's start off at that point. A couple of these companies will be in focus, the OMCs, the paint companies, Interglobe as well. What do you like from the pack?
Yeah, good morning, Nigel, and thank you for having me on your show. Just one company, usual disclosures, Indigo, Interglobe Aviation. I think that it's in a nice sweet pocket at this point of time. Despite all the consolidation in the airline industry certainly has been benefiting Indigo. And recently, I think we saw that for the last month, there was 11% bump up in the volume of traffic. And a lot of pricing power has come back to the airlines. If you see optically also, all the flights are going full. At a time like this, I think they will retain a large part of the benefit which is coming in from lower crude oil prices. So very positive on that company, reasonable valuations, and good growth prospects from expansion into overseas markets or international routes as well.
Okay, fair enough. Deepan, hi, morning. You, of course, as we've been discussing, turned negative early and have been constructive, sounding more constructive over the last few times we've interacted. So this is it. The moment is here, Deepan, in a broader sense. I'm using that term liberally, that we start to get more constructive. I mean, now, of course, we've got calls and we'll put these out on the institutional side as well. I saw something from Jefferies. I saw something from, I think, Nigel CLSA it was, or Goldman?
BOFA.
BOFA, Bank of America. Amish. Yep. So, the voices are coming together that maybe time to get in, time to buy. Just your thoughts, Deepan, on the broader setup.
Yeah. No, good morning, Prashant, and thank you for remembering that I had turned negative early, and now I'm pretty constructive is a nice word to use, and very optimistic as well. And unless something goes drastically wrong on the Trump tariff front, or there's some again geopolitical event or something, I think the market is near about its bottom. And I know a lot of analysts and fund managers feel that stocks are still quite expensive. But at the same time, there's still quite strong liquidity coming into the markets as well. The IPO market has dried up, and that usually takes 4 to 6 weeks to kind of rev up. And we are seeing slower pace of sales from promoters, and QIPs also have kind of reduced. So in a few weeks' time, we should be getting into a nice liquidity position as well. So I feel that markets are looking good. It's a challenge in terms of identifying the sectors and the right stocks, but I think a lot of choices are there. Only thing we want to avoid at this point of time is any external focused business, because don't know what's happening over there. But within the domestic focused businesses, I think banks, which are a large part of any sensex nifty, they should do very well because of various efforts being taken. And cyclically also, I think we're seeing upswing in overall urban consumption. So some of the investment themes have certainly turned quite attractive.
Deepan, hi. Good to have you on the show this morning. Let's discuss auto, because it's all happening, right? We heard those headlines, and it seems that the showroom has already been decided. It's going to be BKC, and I'm talking about Tesla. We still don't know what is the duty value going to be. So ultimately, how much those cars are going to cost. But for the listed auto space, would there be any concern? Would you look at an M&M differently? There are already lots of views in the market that maybe the M&M correction is overdone. But what's your sense? And also a call on the other passenger vehicle makers, where numbers are very weak.
Hey, good morning, Subhi. I think this entire import duty reduction on imported cars has affected the sentiment in the auto sector per se. I don't think fundamentally anything has changed, but they are in a soft pocket when it comes to demand. But look, then valuations also are quite attractive. Long-term growth trajectory is pretty decent for these companies. Interest rate cut will certainly benefit auto volumes as well. And lower cost of transportation also sometimes acts as a trigger. So actually the fundamentals are the way they are, just that this entire new threat has come. And we don't know how it's going to play out also, whether there are going to be quantitative restrictions or it's going to be unlimited imports. Unlimited imports certainly will be damaging at zero custom duty will be damaging to the industry. So I would just say that given the situation and the entire outlook, just be a bit cautious on auto, just wait and watch. I think that sector may underperform and the stocks may get even more attractive. But yes, I think, Mahindra & Mahindra and Eicher Motors, two companies are certainly reached levels where they can outperform going forward. So these are the kind of two stocks that we like within the sector where investors could be overweight.
Okay, all right. Deepan, request you to stay with us. The travel, tourism, luxury theme continues to remain quite strong, and those stocks as well have been quite strong. So let's get chatting with the management of Sami Hotels. Mr. Ashish Jakanwala, the CMD and CEO at Sami Hotels, joins us on the show. Hi, Ashish. Good morning and good to see you in as always. Well, a couple of reports that I was reading, they point out that Bangalore, Pune, NCR, Hyderabad, they have seen on an average, mid-double-digit ARR growth. Is that correct? Would you say that that's the fair number to work with? And that's where you have bulk of your exposure. So I ask you this.
Morning, Nigel. So yeah, absolutely. We've seen phenomenal performance in markets like Bangalore, Hyderabad. Well, first we had Aero Show in Bangalore this quarter. There was a large doctors conference in Hyderabad, but we've seen that these events are now repeating. The name changes, but the events are repeating. So we are heading into a very, very strong quarter. The growth year on year remains to be probably the best in this quarter for us. And absolutely, you're right. The markets that we have our hotels in have been doing really strong for the last few quarters now.
So ARR is in mid double digits. Fair to assume that?
Actually, not just ARR. Total revenue growth is now in double digits. So both ARR and food and beverage income, which we had seen in the past few quarters being slightly softer. But in this quarter, we're seeing both ARRs and food revenue growing in double digits. So it's a fairly good performance.
Okay, all right. So that's good to hear, Ashish. And you're sounding quite optimistic as well. The problem has been the stock market. It's been a little bit wobbly. Are you seeing any kind of impact, the negative wealth impact on occupancies, on business? Any signs you've gradually started observing, or do you think that's not a big problem for you?
No, not really. We've seen the real street performing really well. I've always said that we are delivering our business to largely corporate urban India, and that pocket has been fairly resilient and strong. All the sectors that we feed into, and I was hearing you earlier about the strength of sectors like aviation. And don't forget, as aviation sector grows, so would their contribution to our sector, and the correlation is really high. So we are actually right now betting that as air capacities increase across key markets in India, direct benefactor of that would be actually the hotels. So generally, sectors have done well. The demand sources that we feed into have remained fairly robust.
You have also been monetizing, I believe, some of your properties in the past. I think the Duet Hotel was sold for about 53 crores. Then there was 4 Points by Sheraton in Chennai. So what's the plan? Is there a further pipeline with respect to monetization of more assets? And if yes, then what will you use that money for?
Survi, thanks. I think asset recycling is a part of a core strategy. We believe that as a large owner of hotel assets, we always need to decide what's the best use of our capital. And historically, we have identified some assets where we can pull our capital out, redeploy them in markets where we think our returns are going to be much higher. So you also know that prior to sale of the Chennai asset, we had announced the acquisition of asset in Bangalore. We acquired a leasehold rights on an asset in Hyderabad. So all we are doing is really pulling our capital out in assets where we think the income growth was not very exciting, and redeploying that in assets where we think the income growth is going to be fairly exciting. The asset recycling is going to be continuing through FY26. And in the short term, of course, it impacts the fact that our debt goes down. But in the long term, the whole plan is really to just make sure the capital is deployed at best places.
Okay, so just the point on debt, if you could tell us, some numbers would really help here. How much are you still hoping to monetize through this strategy, say in the new fiscal, FY26? And out of that, how much will the debt go down? So therefore, there'll be a straight flow through in lower finance costs. And how much would be then redeployed in other properties?
So we've done about 53 crores of monetization. We expect additional 150 crores of monetization. I would say that we will give ourselves between 12 to 15 months to complete that. And as I said, in the short term, all of that goes straight into reduction of debt. So you will see, our debt going down by about incrementally 150 crores just through asset monetization, in addition to, of course, the free cash that we're producing from our business.
And how much is that free cash, Ashish? You said 150 crores is going to come in through additional monetization. And what is the total free cash right now?
So free cash, which we will use towards reduction of debt, will be in addition about 80 to 100 crores. So we would see a reduction of about 250 odd crores in net debt during the next 12 to 15 months. And that takes us towards our target. That takes us to our target of, eventually taking the company to around 2.5 times. And in the near term, around 3.5 times net debt to EBITDA.
So around 1,750 crores approximately is what your net debt comes down to in the next 12 months.
That's right.
Right. Ashish, hi, morning. I have a slightly broader hotel industry type of question. We've been, could you tell us what percentage of your business, people who come and stay, is recreational and what is business?
And so I think for us as SAMI, we would say about 85% of the customers we feed into are coming for some sort of a business. They can come through direct corporate bookings, they can come for an event, but about 85% of our business is feeding into business demand. 15% would be feeding into non-business, which would include leisure, people visiting for friends and family, and other personal travel.
Is there another category for business and pleasure? Just kidding.
Yeah.
No, my question is, as markets have come off, and I'm asking you this question on a day when maybe we are looking at least to me, it looks like markets starting to look up a little bit and perhaps more constructive from here. But have you seen any hit to sort of bookings, etc.? Forward
No.
planning, months ahead booking, etc. I mean, at all, nothing.
No, so the business and books remains pretty strong. The business and books remains really strong for March, for April. Our businesses tend to have shorter lead time to booking. So I think it's a bit early to comment on May, beyond, I say, May and June. But the visibility that we have through March and April remains fairly strong when I compare it to the same time last year. I think, I'll repeat, on ground, the sectors that we are feeding to, and a lot of sectors you were talking about in your earlier discussions, those sectors continue to have very strong tailwinds. The basic demand for products and services in India remain to be very strong. We are now feeding almost 80-85% demand to Indian travelers. And this is a big shift from where we were pre-pandemic. So there has been a big shift feeding Indian travelers into our hotels, and the proportion of foreign travelers is really much lower now. So I think all of these factors will help us maintain a fairly stable performance compared to what it used to be, let's say, a decade back, when it used to be fairly volatile because the proportion of foreign travels was way higher.
So, Ashish, that stable performance translates into what? I mean, how much growth? Top line. Where are you likely to end this year? And more importantly, I'm asking for FY26 because you're sounding confident, you're reducing debt. So what's the likely top line trajectory, CAGR, and some sense of maybe margins and the number of keys that you are looking to add in the new year?
So we are right now at about 4,800 operating rooms. We have given a commitment to take it to about 5,600 rooms. And for that, we don't really need to buy anything. All of that inventory is with the company, sitting on its balance sheet. We just need to execute on opening of those hotels and inventory. So that's part one. In terms of margin, we are now closer to about 38-39% reported margins. We definitely see it crossing 40%, stabilizing around 42-43% over the next year and a half. And in terms of total revenue growth, we've always maintained that same-store hotels, and I want to be very clear, same-store hotels will deliver about, I would say, 10-11% total revenue growth over a longer period of time. I'm not talking just next year. And when we add the inventory that we have to add and some of the renovations in our portfolio, I think SAMI would end up delivering about 16-17% total revenue growth over the next 2-3 years.
Well, sounding as solid as ever. Ashish, thanks a lot for joining in. Seems that not impacted at all by the slowdown in the stock market, and business is looking up for you. And because of that, you're going to be reducing some debt as well. Looking forward to chatting up with you at the end of your Q4 numbers as well. Thanks a lot for joining in this morning.
Thanks, Nigel. Thank you, Nigel. Bye.
Time to slip into a short break. We come back. We'll focus on our technicals. We'll have Sudarshan as well as Mitesh who will be joining in.
Okay, welcome back. GIFT Nifty will come up on your screen. I mean, 30-40 point higher start. It's not fully reflecting the big sort of macro changes which has happened. Lower dollar, lower oil, RBI stepping in once again. And we'll see. I mean, but it's a higher start to begin the day. We have Sudarshan and Mitesh with us with the technical trading ideas and what they'd like you to do. Gentlemen, good morning. Good to have both of you here. Sudarshan, you go first. How are things looking? What's the setup?
Yeah, good morning. Well, I'm very pleased. On Tuesday morning, we said the markets are not responding to bad news. Let's go long. That view was continued yesterday, and that view continues today. Again, the markets are not reflecting, as you just said, the gains that we can make. Yesterday night, the GIFT Nifty was 100 points down. So we are now up not just from yesterday's close, but also from the midpoint in say in the evening. So this market is willing to rebound. It's following most other international markets. And finally, we are putting our act together. Now, I can't say whether this is the real thing or it's a dead cat bounce. We don't know that. It's too early. But for today, the trade remains go long on every dip.
Okay, go long on every dip. Got that, Sudarshan. Mitesh, good morning. Welcome to the show as well. You know, the good news is we are underperformed in January as well as in February. We're just starting off March, but at least we've been relative outperformers. Comparison to, the US markets, even comparison to the Chinese markets. But Mitesh, what's your strategy? The gift Nifty suggesting 50-point bump up. Chase the bump up, or you'll wait by for a dip?
So, Nigel, I suggested yesterday that in case we start trading above 22,150, good chance that this pullback can extend to about 22,450, 500 zone, which is where we had the gap down on Friday. So I think the most likely we should see some supply happening over there. We've been maintaining a long bias once we got past 22,150. So I think the idea is that don't chase the gap up, but in case you see a follow through and you see the market head towards 22,450 odd levels, I think that'll be the time to take some profits off on your trading positions and see if the market, faces supply and gives a lower dip to buy into. But otherwise, this market does look like the texture is changing from negative to neutral, though I think we're still far away from turning positive. But I believe that, a lot of stocks are showing formations which suggest that a temporary low could have been made. And therefore, I think trading stocks could be more profitable. But yet, I think on the index also, we have minor long positions. And I believe that the immediate downtrend has been arrested. And getting past 22,500 should add to more strength on the upside.
Okay, all right, got it. Mitesh, good morning. Let's go to Sudarshan as well, get his sense on the market. Sudarshan, how are you looking to, play things in terms of stocks? What would some of the ideas be today?
Yeah, well, it's an all-buy list. Siemens is a buy with a stop under 14,988. Vedant is a buy with a stop under 419. State Bank, and I think this could now outperform, is a buy with a stop under 715. And Alchem is a buying opportunity with a stop under 45.72. Even if it's a dead cat bounce, and we don't know that, even if it is, I think we have some legs to this up move.
Mitesh, what about you?
Prashant, good morning. I also have an all-buy list. The idea is very clearly that trading on the long side in the short term could be more profitable. So I have a buy on Bandhan Bank. It was a buy day before yesterday and yesterday as well. So that's clearly showing signs of a move. Today it's a buy if it starts getting past 148.5, buy then with a stop at 146. Look for targets of 155. A buy on CG Power with a stop at 600 for targets of 640. A buy on Godrej Properties, which is a conditional buy, by about 2085. Keep a stop at 2045. Look for targets of 2190. Disclaimer that we have some long call options positions and there is an intention to add once we see the stock get past 2085. And a buy on Bank of Baroda with a stop at 200 for targets of 215.
All right, gentlemen, thank you very much, both of you, for joining us with that perspective. Really helpful. And we'll come back in a bit from now. There's 6 minutes to go, 5 now to the pre-open session. We'll take a quick commercial break here. We're going to come back in just a bit with, of course, the pre-open rates. Dayanand Mittal of JM Financial Institutional Securities also joins in with his take on what under $70 per barrel mark on Brent oil prices means for OMCs, for ONGC, and of course the oil and gas complex. Stay tuned.
Well, in close to around a minute or so, the pre-open rates will start flashing for you on the screen, and we're bracing for a good trading session. Hopefully, it's not, a disappointing trading session, because yesterday's close was very, very good. And today you have a lot of tailwinds, lower crude prices, softer dollar index, the RBI injecting liquidity into the system. And the markets, well, still down close to 14% from the recent peak. Deepan Mehta is still with us. Deepan, thanks a lot for hanging on with us. Tell us, what's your view on these exchanges? You know, you would have seen expiry on all of these days. You would have seen the market opened at 9:55, then opened at around 9 a.m., then talk about it getting extended. But now it seems the NSE, after a while, is taking the fight to BSE. And now we'll have to see what BSE does next. But BSE in the last few trading sessions has lost close to around 20-25% of its market capitalization. Yesterday it saw a recovery. Your view on the stock?
See, Nigel, I think that these exchange stocks are still quite expensive, but I think MCX certainly is a very interesting position because their options trading volumes is just increasing, and there's hardly any competition over there. BSE, I'd be a bit cautious, because valuations are still on the higher side, and now that trading volumes have come off and all these events have taken place, I would just be a bit cautious on BSE. Maybe at lower levels it would look more interesting. And we need also to track where the NSE IPO is at. At some point of time, this we'll see an NSE IPO. And that has got both positive and negative implications for BSE because it'll get listed on BSE, so it'll kind of generate more cash volumes for BSE. But at the same time, I think that's one exchange will be available to the public to invest in. Right now, the only equity exchange which is available for public to invest in is BSE. So the entire space I would just avoid with the exception of maybe MCX.
Angel One, they have come out with their monthly update. It's looking quite weak, but the stock as well from 3,500 has gone to 2,000 rupees. Bulk of the bad news in the price?
No, Nigel, I don't think so. I think that within the capital market space, you need to be with the wealth managers, the 361 or Nuvama, Anand Rathi Wealth, Prudent. I think those companies have got good, strong annuity incomes and they're focusing over there. And with the wealth effect taking place in India, and more investors going in for advisory or discretionary products, I think the prospects of these asset managers is far, far better than even the stock brokers. And you could add Motilal Oswal also to the list, where the focus is now more on annuity incomes, on fund management, rather than, brokerage, of course, is one of their core businesses. But this contribution is gradually going down over the years, what we have seen, and valuations are very attractive. So within the entire capital market space, I would go with these companies. And if valuations come off, then CAMS and KFIN also are certainly worth watching out for, but not at these levels.
Okay, not at these levels. That's capital markets for you. Deepan, you may want to listen into this next story because this is important. Sources tell CNBC-TV18 that the US government has sought zero tariffs on almost all products traded between India and the US. Parikshit is here with more details. Parikshit, this is obviously going to, it's a bit of a shocker, but some would say, after especially the rollback, exemption, etc. last night, an opening gambit maybe as we enter negotiations?
This is, in a way, the first salvo from the U.S. side. Yesterday, we've seen the first round of formal negotiations between India and the United States on the issue of the bilateral trade agreement, which both leaders, Prime Minister Modi and Donald Trump, committed to sign by the end of this year. Now, yesterday was the first formal negotiation that took place, and the U.S. made it clear that they would want zero for zero tariffs across all product lines, and this includes Tesla cars and automobiles as well. They've excluded agriculture for now. The Indian side has given its response. They have given areas where they can give duty concessions. We have said that we can give access to U.S. industrial goods in a big way, and we want access for our own labor-intensive areas, goods made by our MSMEs as well. So let's see what happens. This was the first set of meetings. Now both sides will go back. The Indian government will deliberate on the suggestions, recommendations of the U.S. government. But initially, we're getting to know that the U.S. side is unlikely to make any carve-outs from reciprocal tariffs that will kick in from the 2nd of April. Currently, this is the U.S. government making its ambition very clear that it wants a very ambitious bilateral trade agreement with India. It wants zero tariffs, and this is in line with what Donald Trump has been saying, that India is a very high tariff jurisdiction, and tariffs on electric cars and ICE cars are more than 100% in India as well.
Okay, so this looks like we don't know how this goes, whether it indeed goes in favor of India or not. Parikshit, the other big story that I think you're also tracking So Tesla's rolling into Mumbai soon?
Very soon now. There's a Maker Maxity mall in BKC where Tesla is likely to open its first showroom. The lease has already been signed. It's effective from February this year for the next 5 years. The total rent for 5 years would be around 25 crore rupees. It's 36 lakhs per month. So that's a 4,000 square feet space. And the lease document says that this area has been taken on rent to showcase Tesla cars. Tesla has also taken some parking slots for charging infrastructure in this building. So it seems that Tesla is moving very fast with its plans to enter BKC. And we are hearing from sources that Tesla could actually time its India announcement along with the launch of its low-cost car in America. These cars are going to be imported from Berlin, is what we're told, and any decision on manufacturing has not been taken as yet.
Okay, all right. 36 lakhs per month. What was the rent Zara was paying? Do you guys remember that Zara store in Fort?
Which is now shut down.
Yeah, because that store, the reason that went, I think, viral is because of the rents, and that sparked a big debate.
I think 7.5 lakh daily rent or something. Was that correct? I'll just come back.
But yeah, maybe whatever, lakhs safely. Thank you very much, Parikshit, for that.
Yes. 7.5 lakhs daily rent.
Daily?
Daily.
So this is Mr. Musk has gotten a deal for himself in BKC.
And it's a good place, right? That's where all the big shot financial biscuits are.
Apple one, right? Maker Max.
I think it's close to the entry point of BKC, but we don't know the exact location. I think it's close to the entry point. But I'm saying it's a good place to be in, like all the
I think
swanky...
it is the Apple, and I think all the
where the Apple store is,
that complex basically. I just want to quickly point out what the Nifty, the pre-open, that is much better. The GIFT Nifty was indicating, I was saying this, 35, 40 points is not fully reflecting what's gone on last night. This is better. This is more like it. 140 points, 0.6% higher, at about 22,480 at this stage. So much more robust kind of open is what it's looking like, guys.
Okay, all right. Well, let's focus on a clutch of stocks that have opened up well in the green. And the last few trading sessions, they've done quite well. The OMCs and the oil-related plays, because we have overnight Brent crude prices which fell, sub that $70 per barrel mark on OPEC plus plans to hike output. To decode this, we have with us Dayanand Mittal, the oil and gas research analyst at JM Financial. Hi, Dayanand. Good morning, and thanks a lot for joining in. Well, crude oil prices are lower, so let's focus on the OMC piece first. They have been relative underperformers, but now you have valuations in favor, yields as well in favor, and dare I say that we don't have a state election for the next many months as well, which could bode well for them. What's your top pick from the OMC space, and what are you factoring in now in terms of Brent crude prices? I think earlier it was around $75 per barrel, which has been revised downwards. Tell us more.
Yeah, so first to start with crude price outlook, given that's what will decide the fate of OMCs and ONGC Oil India. So we have been a bit bullish on crude over last 2 years, expecting crude to be supported around 75, 80, which kind of largely played out, given OPEC had a very strong pricing power. But that pricing power has gradually got eroded, given that we are heading from a deficit scenario in terms of global oil demand supply into a more surplus scenario in CY25. So it'll be about at a 0.5 million barrels per day surplus in CY25 versus deficit in last 2 calendar years. So adding to that erosion in pricing power for OPEC, the entry of US President Trump push to Saudi and OPEC to lower oil prices added to the pressure on oil prices. And we believe that's a key reason why OPEC Plus eventually decided to hike output after being delaying it for last year or so. So we believe, though this came as a negative surprise for us and for market, and hence oil is now closer to $70, we don't see a scenario where oil goes down to $60 or so, because I think the key thing which will decide whether oil is at 60 or 70 is what is US President Trump's desire. We believe he just doesn't want a lower oil price for his US consumers, but he also wants an oil price which is supportive of US oil and gas companies, particularly all those who are doing capex in US shale. And our sense is they need $65 to $70 to justify the project viability. So our sense is $70 is what US president would ideally like oil to be at, and not 60. And second reason is given the favorable relationship between President Trump and Saudi obliging to his call for lower oil price. So he would not like to push Saudi beyond a certain point. So Saudi's fiscal break-even is around $85. Saudi has obliged to President's call for lower oil price and hence their hiked output. We don't think US would like to pressure Saudi to take oil to 60 because that could significantly hurt the fiscal deficit. If that were to happen, we think Saudi will make a reverse, a U-turn in their output hike decision, and they will either pause this output hike or maybe even go for a cut as well. So $70 is what we are working with. So given that backdrop in oil, OMCs, we have been negative since last 2 years. Valuations have now become more favorable. They're trading at about 1.1 time price to book, which is in line with historical average. So risk reward is now more balanced, and hence, though we have still maintain a cautious view, but we think the risk reward is balanced, and one can, if one has a bearish view on crude, maybe they can take a more constructive view on OMCs. We still think crude would be supportive of 70, so we prefer ONGC Oil India or OMCs even at this juncture.
Okay, so you prefer the OMCs, you're saying. For Dayanand,
ONGC
for
Oil India or OMCs.
ONGC Oil India over the OMCs. For OMCs with this kind of a reduction, I mean, what is the, there's of course on the marketing side, if they don't pass it on, then it becomes better marketing margin. On the refining side, I mean, in general, what's the sense on GRMs?
Yeah, so first on the marketing piece, we all know, given the history, that this is not a sustainable earnings that they'll be making. Current marketing margin on auto fuel has jumped to 8 to 9 rupee per litre versus historical 3.5. So we all know if crude stays here, government will either hike excise duty on auto fuel to boost its revenue or maybe pass it on to consumers. So we are building a sustainable marketing margin of about 4.2 rupee per litre, still higher than 3.5. Excluding LPG losses, and if you were to adjust for LPG losses, then you're building in closer to 6.5 to 7 rupee per litre auto fuel marketing margin. In terms of GRM, there have been a bit negative surprises, particularly OMCs and all the Indian refiners have been enjoying about $1 to $1.5 benefit in terms of the GRM because of Russian crude discount. Given the US renewed sanctions on Russia by the Biden administration in Jan, that is likely to lead to sharp decline in OMCs or all the refiners Russian crude import from about 35-40% to maybe sub 20%. More clarity will emerge over the next few months. And also the discount will narrow from $3 to $4 to maybe sub $1-2. So that will be one hit to their GRMs. And second is excluding diesel, where cracks are still reasonable at $15 in line with historical average. Other product cracks, gasoline and others have been a bit soft because of weak global macro setup. So yeah, overall GRM has surprised negatively over the last 2-3 quarters.
Dayanand, I think I had one more, but I think we'll have to save it for the next time we speak. We're just 3 minutes away from market open. Thank you very much for joining us.
Thanks a lot.
It's a pleasure speaking with you. Well, let's get 9-10 calls, 9-12 calls now actually. Sudarshan and Mitesh are with us. Sudarshan, what do you have?
Well, consider buying State Bank. Buy State Bank with a stop under 715.
Okay, SBI with a stop under 715. Stocks up 3/4, 6 rupees higher. Mitesh, what about you?
I'll go with PSU Bank as well, Bank of Baroda, for targets of 2 and 5.
All right. The one name, thank you very much, both of you. The one name which, of course, has gone down one way for a while now has been Reliance Industries. Now, Sudarshan is here. There are, at the margin, some positive voices which are starting to come through. I think Jefferies is one. There are others as well. So take it away.
So two positive notes have come in for Reliance Industries. One is from Kotak and another is from Jefferies. Kotak is expecting an upside of around 16%, while Jefferies is expecting an upside of more than 30% from current levels. Now, what does Kotak say? First, it has upgraded the stock to buy and target is 1,400 per share. It says subdued retail was the key reason for the recent stock underperformance, and it expects store rationalization cycle to end very soon. But it has cut FY26-27 EBITDA estimates by 1 to 3%. But despite the cut, it expects earnings CAGR of 11% over FY 24-27. Now, giving the reasoning behind it, it says with significant correction, risk reward is more favorable. Second, retail business will likely improve in next few quarters. And key catalyst, it says, Jio Platforms IPO timeline and likely another tariff hike. These two would be major catalysts as per Kotak. Now coming to Jefferies, it maintains buy call and target is rupees 1600. It says underperformance was due to slowdown retail and subdued O2C earnings, and pessimism seems very extreme. It says current market cap is implying $48 billion EV for retail versus $106 billion in last funding round. It says store sales growth and area addition should restore 15% growth for retail in FY26. And like Kotak, Jefferies also says that tariff hike and likely listing of Jio and improvement in O2C will be likely key triggers going forward for Reliance Industries.
All right. Thank you very much for that. So the RIL, of course, is the big one, and it's not pulled its weight yet at all. And if it starts to, it will make a big difference to indices, etc. as well. 22,500 nearly on the Nifty. That's about 0.6% higher. Much better than, for some reason, GIFT Nifty was not reflecting it. But the pre-open date, 0.5% now. Nifty Bank is up 0.6%. We've got the mid-cap index, which is up 1. Remember, the mid and small-cap indices were up 2% apiece yesterday. Advanced decline is positive, 6:1, but it's just starting, so many stocks still yet to open up. And it's all green on the Nifty heat map. Just 3 or 4 names in the red: Infy, Bharti, Nestle, SBI Life, but everything else is starting the day higher. So it's 3-digit gains, nearly 100 points, 22,433 at the very beginning. Surabhi.
Before I talk about the Nifty stocks, I want to pull up one stock that I was actually observing for the last several weeks, and that's Castrol India. Castrol is one stock that hasn't fallen as much as the rest of the market. In fact, for the year as a whole, Castrol is still up 18% in 2025. Today, it's rallying 5%, and now we know why, because it's become very clear. Saudi giant Aramco has made its intentions clear that it wants to buy BP's lubricant business, which is Castrol, and they're very interested in key markets like India and China. So we have to get to the bottom of this, what this would mean for the listed entity here. But that explains the resilience that stock has showcased over the last many weeks, including, of course, today it's looking good. Now on the Nifty, let's look at the key movers and shakers. A lot of the commodity stocks are flying high. BPCL is about 3% higher. Reliance 2% higher. Hindalco is 1.5% higher. Tata Steel's up and about as well. A lot of enthusiasm around the whole China boost as well coming in for these stocks. Shriram Finance 2% up. Tata Motors is seeing some buying this morning. Coal India, Eicher Motors, Bajaj Auto, these are the other names on the upside. So it's a very broad move, and most parts of the large cap screen are moving higher. Relatively speaking, Infosys is the one that kind of stands out. It's seeing some selling today, but it's not the whole IT pack that's down. It's actually more Infosys. And Britannia is mildly lower, about 0.7% lower. But otherwise, it's a green-looking screen, lots of financial names. Autos definitely bouncing back, and commodities, oil and gas, metals, material stocks like Coal India, all of them moving higher.
Well, Surabhi, there's one stock I'll be looking at is Z. That stock is absolutely bombed out. And if you look at the exchange filing, you'll see the promoter has bought close to around 27 lakh shares from the open market. Remember, promoter holding was a little bit south of 4%. But now we're seeing that it's added close to around 0.28%. So that could be, the stock was sub 100 rupees and some kind of promoter buying. Keep an eye out on that stock. A big underperformer, promoter chipping in after a while. So that's one stock I'm looking at. Man Industries is another stock that's moving higher on large volumes. Keep in mind that the stock has seen a sharp correction from the recent peak. Yesterday, it was up close to, I think, 15-20% or thereabouts. Man Industries. Today, it's up close to around 5%. And the volumes are large. If I remember correctly, the recent high was 450 rupees plus. So after halving, the stock actually is bouncing back. IOL Chemicals. They have got a certificate of suitability from the EU regulator. So that stock is up close to around 4.5%. And ACME Solar, that's another company. We had the management joining us on the show just a few sessions ago. That stock, in fact, is up close to around 5% as we speak. Volumes as well, fairly high out there. They are very, very adventurous brands. Acme Solar, that should come up for you on the screen. Besides that, some of these other big movers from the broader markets. You have Root Mobile that's up and about in today's trading session. Big move is what we're seeing out there. Triveni Turbines, another stock that's up close to around 6%. So a pretty good looking screen, guys. And big boy Reliance Industries had opened up in the green. 1,220 is the 20 DMA. You'll want that big boy to get past that mark, which will brace
for a bigger move if you have to see a breakout on the upside. So that's the technical level, 1,220.
All right, let's have that stock up. That Reliance, we'll look at that. 110 points, by the way, that's RIL. So 1,200 basically is where Reliance is at, 2% higher. Well, 100 points on the Nifty is what you have, 22,450. And that is, it's looking good. And we'll see, we'll be able to build on this or not as we go along. Just a few other names where things are opening up with strong volumes. We did mention the OMC's HP, of course, is standing out with that 5% pop. Out of the three, HP is the biggest volume-led gainer. Castrol, we already highlighted. Triveni Turbine, Nigel just highlighted. Chennai Petro is up 5%. So standalone refiners, Chennai, and maybe we should look at the other one as well, MRPL, and 240,000 shares. So good volumes as well. MRPL is up 4%. Yeah. Root Mobile, if you mentioned that, 8% higher on Root, 1,085. There is IOL, I think we did mention 5% on IOL, 343. That'll come up. Shakti Pumps is back to being up 5%, limit up a day. It was up 5 yesterday, 5 today. But of course, I mean, from 1,200 rupee levels, it had fallen to 800 one way as well. So some recoveries coming through. Sapphire is up, Sapphire Foods, 8% higher, 334 on that. And it's got it doesn't have too much volume, so be mindful there. So let it settle down. There is Quick Heal, which is up 5.5%. First Cry is up 5%. Recent listing, First Cry. But again, I mean, don't want to emphasize too much on these names because volumes are lacking. Very small volume. They're going up on little volumes at this stage. On the downside, there isn't very much at all. I mean, I think you want to look at, say, 3% as the cutoff, there are two names with volumes. I mean, there may be more, but with decent sized volumes, there is Azad Engineering. And we had the management with us yesterday. So 1,300 on Azad Engineering. And there is Bharati Hexacom, which is down 3% as well. So about 1,336 on this one. Otherwise, it's all, 0.5%, 1%. Narayana, of course, it made a new high while the market was sinking. So it's just seeing a 1.5% pullback. That's it. So it's a pretty good looking, decent looking screen at this stage. Well, we have Mahesh Patil, who's our market master of the day. He's Chief Investment Officer at Aditya Birla Sun Life Asset Management Company. Mahesh, good morning. Great to have you with us here on the program. Prashant here. Your note says, why now is the time to invest? So I'm going to just put that to you. 2-3 bullet points. Why do you think so, Mahesh?
Yeah, hi, good morning again. So I think clearly, what we're seeing is that some of the factors, right, which were hurting the growth and the slowdown, what we've seen in the first half of this fiscal year, I think some of these things are easing off. Clearly, we see from the fiscal side, there's a boost to consumption, which is there. I think which should kind of translate into better consumption growth, which was weak. On the monetary policy side, we've seen that the tightening which was there in the first half, we've seen that starting to ease off a bit. The policy environment, the new RBI governor has come on board. We've seen the rate cut. We've also seen a great amount of liquidity infusion. Yesterday, they infused around 1 lakh of OMOs to reduce the system liquidity, which was a negative territory. And I think that should also spur kind of a growth. So we see, I think, even the GDP number which came in for the third quarter was around 6.3%. So I think we are probably well on track again on recovery over here. And next year, we should be around 6.5% GDP growth. And even the corporate earnings growth, which this year has seen a big downgrade to earnings, I think slowly, it should start to recover again from the second half of this calendar year. So that's on the fundamental side. But more importantly, I think on the valuation side, after the recent correction, both in Nifty and also in the mid and small cap indices, and the Nifty, at least the valuation now is slightly below the long-term average, the P multiple, if you look at it. And mind you, if you look at the ROE of the Nifty is well above the long-term average. So that means clearly the market, the risk-reward here looks favorable. Having said that, markets can always undershoot on the downside, but clearly for a long-term investor who's looking at a 3-year view, I think this is a good time to dip in. And recently also we've seen that a couple of other positives in terms of oil prices, which have come down below 70. I think that should help to contain inflation. And with that, I think there's a good chance that in the next policy, again, you could see a rate cut or further easing, which could be possible. And also on the global front, the DXY, which was kind of rallying, and we saw sharp rally since September when Trump elections came to power. But that is also now kind of easing up and stabilizing. So I think the pressure of the rupee is also kind of now stabilizing. And the rupee depreciation actually now is a kind of a boon in terms of earnings, because I think once this rupee stabilizes, the 5-6% correction would mean that the top line growth of a lot of companies, if you get 50-60% of the top line of corporate India, is somewhere linked to the rupee dollar rate. So that should also, I think, once settled down in the next financial year, that would probably add a bit to the earnings. So I think we think that the worst is looking in. The overall indicators, like if you look at the breadth of the market in terms of number of stocks, okay, which are below 30%, that is at a kind of a highest level what we have seen, except during the COVID crisis and during the global financial crisis. So clearly, it is oversold. It's a good time for an outlook to really step in, and you might see a slow and gradual recovery from here.
Mahesh, hi. Good to hear that. Yeah, I think that's almost the near consensus view that it's a good time to start adding to positions now. Perhaps we've seen the worst. But the question is, what next, right? This market, since COVID, has been used to these quick bounces, V-shaped recoveries, right? And it's usually been a very momentum-heavy market where stocks overshoot on valuations on the upside, PSUs, etc. So the question is, from here on, should you create a portfolio for a longer period of consolidation, maybe a more defensive portfolio for the next 1.5 years? Or should you, create a portfolio with animal spirits, which means go back to industrials, go back to stocks, the usual names, whether it is EMS, industrials, CapEx, etc., which led the previous arm or the previous leg of the bull market? What is the approach you would take?
That's a very good question. So I think we would not see a kind of a sharp recovery. I think the market momentum clearly has broken, as we've seen in the last 6 months or so. And there is some amount of pain which is there. Even the corporate earnings recovery, okay, will be slow and gradual. So, and on the global front, you'll hear these noises. So I think it will be a market where you will see some bounces, some correction, and it will probably consolidate for some time, right? Because this correction started around since September. So we are like less than 6 months. Normally, it will take at least a year, okay, where the market consolidates and tries to make a new high. That's first. Secondly, is that I think whenever this market undergoes such a sharp and deep correction, what we see is that the sectors or the themes which were doing well in the earlier part of the rally, okay, that leadership starts to change and new sectors starts to emerge. So I think some of the sectors which did very well in the earlier period because of either the growth momentum or because of the liquidity flow which rallied behind some of these stocks, I think that will likely to change. And that's why we think that in this going forward from here, you will see sector leadership clearly changing. For example, like banking sector, right, which has underperformed in the last cycle. We see that sector doing well. Again, a lot of the headwinds there, which were there from the regulatory side, I think that is starting to ease off a bit. The earnings growth will not be as great because rate cuts happen, but a lot of that is pricing. Valuations are reasonable. And if recovery happens in the economy, you see credit growth again coming back over there. Similarly, sectors like, for example, the cement, metal space, which have kind of underwhelmed in the previous cycle, I think these could probably come back. And amongst the sector leaders, okay, which was in the earlier cycle, I think wherever the corrections have happened and valuations have become reasonable and the growth outlook is fairly good, whether it's in the industrials, capital goods sector, I think it will be more stock specific, I think, going forward in those sectors.
Okay, all right. Hi, Mahesh. Good morning. And you're sounding quite optimistic. The other data point was on the technical front. I think the number of stocks in the NSE 500 that were trading below the 200 DMA was the highest. I think even in peak financial crisis, we didn't have 90% of them were trading below the 200 DMA. So that's telling you the kind of pain that we saw from the broader markets in particular. But as you've highlighted in your note, asset allocation is going to be key because you have limited money. But now how would you allocate money? How much to equity, how much to fixed income, and how much to, say, gold? What is it right now? And how has it changed, say, in comparison to 6 months ago? Because at that point of time, I think equity could have been relatively lower. Now, going by what you're saying, you'd like to up the ante, I think, out there. Tell us.
Yeah. No, okay, so I think by and large, I think what we're seeing is that the risk return across asset classes, right, is going to be reasonable compared to the risk-adjusted returns long term. So fixed income also, we think this year can be a good year, okay, where you could make 8 to 9% return as interest rates come down. Gold is a good hedge. Okay, we've seen that play out last year, also the early part of this calendar year. So that will provide this stability. So an asset allocation fund would be a great approach for investors to time the volatility, because we don't see any oversized return in any particular asset class. So that's the first thing. And in terms of asset allocation, so we run a asset allocation, multi-asset allocation fund and balanced advantage fund, wherein we express our views in terms of what is the allocation towards more between equity and debt. So in that fund, our allocation, for example, around 6 months back, used to be around, we were going as low as around 37% or so, and we were around 14% for quite some time. And in the beginning of this calendar year, we slowly started to increase because some of our indicators in terms of the valuation and also some of the counter-cyclical indicators which we look at. So that started suggesting that starting time to develop. And currently, we are around 62% in that fund. So that suggests how we have a good asset allocation as the markets have corrected, and some of the counter-cyclical indicators are suggesting that this is a good time to really enter into the market. Having said that, there could still be drawdowns in the market. I think we're not seeing that there won't be drawdowns. But I think those drawdowns are periods, okay, where one needs to buy, because there is really now, at least as a fund manager, I see good value emerging in stocks, okay, which really want to buy from a long-term perspective, which earlier you couldn't really, because the valuations didn't really fit into your growth valuation framework.
So the current percentage is what? Equity, debt, gold? Sorry, we just missed that.
So
the exact
currently
numbers.
in a balanced advantage fund, okay, where it is only debt and equity, it is around 62% currently. And in a multi-asset allocation fund, okay, where we don't do too much of our asset allocation shift, but there our equity allocation is around 62%, gold and silver is around 17%, and balance is into debt. And also, we find REIT invest also kind of attractive, okay, because they offer IRRs anywhere between 10 to 11%. So we have exposure of around 4 to 5% on REITs and invests.
Okay, all right, Mahesh, we will wrap it up on that note. Thank you very much for joining in and giving us a sense of how to approach the market now after what has been a 6-month-old correction, prolonged correction. Is it over? Well, we'll only know in hindsight, but the last 2 days have been good. In fact, the market, look at that. Look at what's happened. Now, this is exactly the problem that did not occur yesterday. The bounces were not getting sold into. It was a great positive. But this morning, there is some uncertainty. And I think this whole business with, till now, it was everybody else's problem. We were watching on the sidelines, US, Canada, Mexico, China, who's levying what tariff, counter tariff on what. Now it boils down to us. What is the deal that India can negotiate with the US with respect to tariffs? And if we indeed have to bring down import duties to zero on a lot of products, how is that going to complicate further the local growth landscape? I think that's a bigger macro issue. But the market anyway is choosing to sell off for the time being.
I have an easy explanation.
Okay.
I just stepped out to take a call.
Okay.
The market sold.
That's true. Our lucky mascot was missing. Now it should turn around, right, from here.
But it's as you said, it's a sharp. I mean, it was up when 100 points up, and now it's down about 10 points or so. So, yeah, I mean, more on this coming up. But I think we have the management of REC with us.
Yes, we do have, REC, the management joining in. And, of course, power financiers have been in focus as well. A recent brokerage note said that the structural story for power financiers is very much intact. And that note largely is saying that due to lower credit risk, strong ROEs and valuations, many of these stocks are still looking good and they're inexpensive. This was a foreign brokerage that wrote. CLSA gave that view on REC and PFC. So how is the actual business on ground? Well, joining in to understand that, we have the CMD Vivek Kumar Devangan, ED Finance Harsh Baveja, and VK Singh, the ED Projects. Thank you very much for joining in, Mr. Devangan. I'll start with you. Good morning. So as you can see, I mean, the markets are still holding on to hope that your numbers will keep looking good as we go forward. But before the growth question, I want to come to the question in terms of your borrowing mix and the cost of funds, because the RBI has been taking increasing number of steps to boost liquidity in the markets. If you could just explain your borrowing mix right now to us and what the future has in store, the near future, in terms of margins. Can investors hope for any increase?
We use a judicious mix of our borrowing. Our 40% of borrowing is from domestic corporate bonds, about 18% is from domestic bank term loan. And we have instrument called 54EC bond, that is capital gains tax saving instrument, that constitute about 10% of our borrowing. And our external commercial borrowing is around 30%. That has also, we have used hedging techniques, innovative hedging techniques, and we have been able to bring down our cost of fund to about 7.15% at the end of Q3. We hope that we'll be able to hold on to our spread of about 2.94 to 3% and net interest margin of 3.64% to about 3.7% going forward.
Gentlemen, it's so great to see the full strength of the REC team. Mr. Devangan, Mr. Baveja, Mr. Singh, on the finance side, project execution side, and of course, Mr. Devangan, as we always speak with you. So it's good to see all three of you here. Just give us a sense of, Mr. Devangan, how 2025 really will pan out in terms of disbursements, pace of growth. Is the focus on renewables absolutely going to remain unaltered? The reason I'm asking that is because, US is the big source of capital around the world. The US seems to be changing direction ever so slightly. And everybody else seems to be following the lead. Will we see any change in, of course, it will have to come from the government in that sense, but what is your own perspective, sir? If you can give us that broad sense, and we'll go back into micros again. Go on, sir.
Yeah, as far as the disbursement is concerned, you might have observed that our disbursement had increased by 19% at the end of Q3. And last year, total, our disbursement was to the tune of about 1,61,000 crore. I'm happy to share with you that we already crossed that mark in the current financial year. We already crossed disbursement of about 1,68,000 crore. And we hope that our disbursement will be increased as compared to last year in the range of 18 to 20%. And since we have large pipeline of projects, we already sanctioned number of projects, particularly with regard to renewable energy projects. As I had told you earlier, that on the sidelines of Energy Transition Working Group in Goa in July 2023, we had signed MOUs worth 2,86,000 crore. And I'm happy to share with you that we have already sanctioned projects more than 1,60,000 crore for those MOUs. And we have a huge pipeline of projects, and we hope that our loan book from renewable energy, which is at present 10% of our asset under management, which will go to about 30% of our asset under management to the tune of about 3 lakh crore by the end of 2030.
All right. Hi, sir. Good morning and good to see you all in. Just to reconfirm the numbers for this year, disbursement growth you're guiding for high double digits. Is that correct? And NIMs you mentioned about 3.6%. Is that the number?
Yes, disbursement would be around 18 to 20% increase, and NIM will be about 3.64% to 3.7%.
Got it. Okay, all right. So we've got that cleared out of the way. The other big factor that the street will be looking forward to is going to be write back of assets and resolution of assets as well. So could you tell us how much has been done? For this year, what is the number we should work with? And for the following year as well, what kind of number should we work with?
I'm happy that you asked this question. Today, we are going to get about 2,600 crore payout from KSK Mahanadi. Our recovery from KSK Mahanadi is going to be more than 100%. Total, the proceed that we are likely to get in the month of March is about 2,764 crore. We have also got very good resolution from Bhadreshwar project, which has, there also we are getting very good write back. Then senior plant in Nasik, there also our recovery is going to be very good. And Hiranmai in West Bengal, there also our recovery is going to be very good. The total write back that we are assuming, it may go around 2,500 to 3,000 crore in the current financial year.
Sir, one more point, and I want to draw your attention, and maybe the others on the panel could also take this up. there was this report that the IMF put out, and what the IMF study is saying that NBFC's concentrated exposure to large infrastructure projects, specifically state-run, state-controlled NBFCs, this large concentrated exposure, this could perhaps in the future start creating some systemic risks for the financial sector as a whole, for financial sector stability. Your thoughts? I don't know if you saw this report, Mr. Devangan, and maybe Mr. Baveja can chip in, whether this causes any room to worry. I mean, it is the International Monetary Fund and their study that's throwing this up. They did not name REC or any entity in particular, I think, but they're saying large state-run enterprises that fund infrastructure. There could be a systemic issue over here. Sir.
Yeah, there have been some concern about the debt sustainability of the state utilities. But as we go by the history, not a single state utility has defaulted so far, and they are supported by the state government guarantees. And we have made a detailed analysis actually for the state utilities because there have been concerns about their debt sustainability. So we are taking due precaution, and additional prudential norms have been stipulated by Ministry Power that we are strictly following so as to avoid any unnecessary exposure. And we are ensuring that close monitoring of this project is being carried out by our project monitoring group. I'll request my Director of Finance to substantiate further on this issue.
Mr. Baveja, are you seeing pockets of stress build up anywhere? And is this this concern on systemic stability, financial sector stability, is it valid?
No, their point is very valid, but I'll come to from the perspective of the REC. That we have 88% loan book consists of the funding to the state government and state government agencies, and 12% is from the private sector. So as far as the state government fundings are concerned, we have never experienced in the last 10 or 15 years any kind of restructuring request or the delays in the repayments or the NPAs accruing. Bearing one or two cases where they have slipped to the stage 2, but that is a regular phenomena. Sometimes administrative delays are there. So we have a robust appraisal system, and on the basis of the revenue sustainability of the project, we used to fund the projects. In case if any of the projects which is non-capex, generally from the state government utilities, we take the loans, we disburse the loan against the government guarantee. So our the loan is properly secured.
Got it. Just one more question on financing. There was a recent media in that 12%, which is to the private IPPs, etc., private sector, Mr. Baveja, there was another article recently which said that the RBI has asked, financial institutions to stop giving lines of credit to corporates. Is there any, generally that is not there as a practice. It's not widespread now, and I'm assuming those can be replaced with term loans. But at REC, is that a practice at all, Mr. Baveja?
That point is very well taken. In fact, what is happening that we don't give any kind of working capital funding to the private sector. And as far as the government sector is concerned, government utility distribution utilities are concerned, the government of India has already mandated that there should not be more than 35% of this. They have kept a ceiling of 35%. So beyond that, we cannot give them the working capital limit. So taken all together from all financial institutions, their working capital limit will not exceed the 35% of their revenue for the last year. So we are keeping that ceiling intact, and within that limit, we have given them, if any working capital limit is sanctioned, that is towards that, and that is within the ceiling.
Okay, just a final point, and again, we're just kind of trying to check if some of these reports are valid or not, and whether these concerns are valid or not. Mr. Singh, if I could come to you for this quick last bit. There are some press reports indicating that on the renewable side, there's a bit of an issue because there's a mismatch between the renewable, generation, the capacity, and the transmission capacity. So, some several gigawatts, I think 60 gigawatts is a number that's doing the rounds, that kind of, capacity is stuck. How much is REC right now lending to renewables? I mean, as a percentage, how much is, traditional thermal power and how much is renewables? And are you noticing this, on the renewable side? Is this becoming an issue in terms of the repayments that you would expect?
So, in terms of loan book, renewable energy constitutes roughly 10% of our total loan book. And whenever we take a funding of any renewable energy project, we first ensure that the evacuation system in particular is in place. So when a project comes up for lending, there are multiple things. And the prominent about those multiple things is PPA, availability of PPA, availability of connectivity, availability of entire evacuation system, and then only we take up the project for lending. So as such, in our lending, of course, this is not an issue, but yes, in this sector, there are minor issues in terms of evacuation, but the lot of work is actually happening on this particular front, where evacuation perhaps as of now is not a constant in evacuating renewable energy power.
Just one more thing, Mr. Singh, on the infrastructure side, that's a fast-growing area for you. What could you tell us? I think you sanctioned about 20,000 crores worth of loans last quarter. What's going to be the growth here in this segment?
Earlier we were taking up this infrastructure project quite seriously, but then there were many opportunities, particularly in thermal generation space, and many projects actually came our way. So we are now, again, our hands are full with, power sector projects financing. So we are not that much focused on infrastructure lending as of now, since there's a lot to do in power itself. But we are doing small bits in infrastructure lending as well.
Okay, enough to do in power, so that's the focus. Thank you very much, all three of you, Mr. Singh, Mr. Baveja, Mr. Devangan. Appreciate the three of you coming on and speaking with us here for our audience at CNBC-TV18. We'll take a quick commercial break here. We have the management of HUDCO coming up next to discuss demand trends going forward. Stay tuned.
Welcome back. The color has turned red on the screen, not just for the Nifty, but the Bank Nifty as well. Both those indices are down. Saving grace is mid-caps. Mid-cap index is still holding on to gains of around 0.75%. So it's one of those mornings where the opening gap up gets sold into. Let's see, it's still a long day. Maybe we'll have more waves of buying as we go along. Right now, we are moving on to the next company in focus, and HUDCO is the one that we are talking about. We have with us Mr. Sanjay Kulshrestha, Chairman and Managing Director at HUDCO, joining in for some perspective on how business is shaping up as the financial year is now almost coming to an end. Mr. Kulshrestha, great to have you on the show, sir. Thanks for joining in. So I remember our earlier good morning. I remember our earlier conversations with you, and HUDCO has been, of course, very, very ambitious in terms of growth, especially near-term growth. You've told us the next maybe 1 to 2 years will see frenetic growth. It could be as much as 30% plus before the CAGR stables out. So just to talk about how this year is ending for you, can you give us some sense of how the fourth quarter has been? And it's this quarter where the RBI has taken a lot of measures in terms of boosting liquidity. You've got a rate cut as well. So is that giving a bit of a tailwind to margins?
Yeah, thank you so much. And I will start from the background that the government of India has now more focused and more taking measures on an expeditious manner for creation of the infrastructure for Viksit Bharat. And HUDCO is a company which can fund across the sectors, starting from the water, sewage, roads, energy, power. So each and every infrastructure sector required a capital infusion. During Q3, you may have seen that our growth was phenomenal, and our loan book was closed at around 1.1 lakh crores, which was an increase of around 41% on a year-to-year basis. So I think the tailwinds are with us, and we are very hopeful because generally in financial institution, Q4 4 is the best quarter for the financial institution. So we are very hopeful that we will be closing this quarter on a big bang, and you can see that already we had already borrowed around 44,000 crores from the market, and we have an ambitious borrowing plan of 55,000. So the indicators are very clear that the growth is coming to be there for the company.
Mr. Kulsheshwar, again, I remember our last conversation so clearly where you said that the focus, I mean, housing obviously remains a focus for HUDCO, but large infrastructure projects, urban infra, that is something that HUDCO is now increasingly getting focused on, right? So if you could just tell us, roughly speaking, by the time we end FY25, out of your total loan book, what will be the ratio between housing and urban infra? And on urban infra, just before you joined us, we were chatting with the REC management. So I'm going to ask the same question to you. There are concerns. There's this IMF report that everyone's talking about, which is saying that, large state-controlled enterprises, lenders to infrastructure, they should be very careful. Otherwise, there could be systemic issues that are arising. Are you seeing any stress in your urban infra book? And how big will the book be by the end of this year?
Yeah, we had gone through the IMF report, and from the very beginning, if you see, we are very, very careful and vigilant while financing the infrastructure project. And this process will continue, and we had to further strengthen our governance system regarding the delegations and regarding the process and the procedures for the sanction and the disbursement of the loan. So we are very, very careful. And you may see that our NPA levels are the best in the market. Our net NPA is only 0.27 and gross is 2.42. And we are possessing to become a zero NPA company within 18 months of time, and all the efforts are being seen. At the same time, we are very, very careful while sanctioning the project. And during last budget, I will just like to give the example that what the government of India is thinking and doing. Honorable Finance Minister has came out with Urban Challenge Fund, which is extending 25% subsidy for urban infrastructure creation. And it is 1 lakh crore subsidy they had announced, the government has announced, and it can channelize around 4 lakh crores of the project. So all these projects can be funded by HUDCO, and only 50% bankability has to be seen, and 25% balance will come from the state government. So you can see with 50% bankability and on 100%, and 50% coming as a subsidy or grant from the government of India and the state government. So we are very hopeful that the large infrastructure projects will come, and HUDCO will be funding, and the bankability will always be there, and we will assure and ensure that there will not be any compromise on these kind of measures.
And what's the mix, sir? End FY25, your loan book, what will be the mix between housing and non-housing?
Mix will be around 60-40 because PMAY 2.0 is yet to take off, and projects are sanctioned, and I think in first to second quarter, the things will start moving, and our disbursement under PMAY 2.0 will also start coming. So we are very hopeful that by 26-27, we will be around 30-70 kind of ratio.
30-70 as in 70 urban infra and 30 housing?
True. Because now we had moved from housing. We are no more a housing finance company. We are an infrastructure finance company. So we have to move.
Okay, all right. So if you could give us a couple of numbers. I recall at the start of the year, you were talking about 1.2 lakh crore. You're already at around, I think, 1.15 lakh crore. So what do you end this year? 1.18. So you're almost there. What's the revised target? What do you end FY25 with? What about FY26? I think earlier you were talking about 1.5 lakh crore approximately, I think so, for the next year. So how would you like to revise this number? And also just give us some color about how state project implementation is progressing. Because, the CAPEX spend for FY25 has been underwhelming. But for FY26, the optimism is there. So give us a couple of numbers, sir.
Yeah, actually, if you see the numbers, I will retain my numbers of 1.2 and 1.5. And this year, I am very, very hopeful we will be crossing by far this 1.2 figure. And similarly, correction has to be made in FY26, looking at the opportunities present in the housing and urban infrastructure. So definitely, there will be an upward revision, but we will take a call in first quarter of the next financial year. You are right that there are a lot of emphasis in FY26 for infrastructure project. FY25 was a bit slow, but I will not say a bit slow because the time we had taken for our policy revisions, and Government of India has came out with a very wonderful budget for the infrastructure. And you had seen that for urban infrastructure, for our ministry, they had allocated around 97,000 crores. It includes the metro, it includes the housing, It includes the industrial housing as well. So Swachh Bharat Mission, Urban Challenge Fund. So all these things have been prepared in last financial year. And now I think there is a lot of scope and leverage that these kind of measures will ride a economically developed kind of infrastructure to be created.
Okay. All right, Mr. Kulshreshtha, we'll leave it on that note. Thank you very much for joining in and good luck with all those plans.
Thank you so much. Thank you very much.
I really appreciate you being with us. Okay, quick check on the market. Still the same story, but the mid-cap index is also now narrowing its gain. Let's pull up the mid-cap index and the advanced decline ratio. This is the Nifty story. There's a bit of a bounce right now. Mid-cap is getting a little volatile. Advanced decline ratio is still very positive. I mean, you've still got almost 2,000 stocks advancing. Let's see how it progresses very early on in the day. Moving on, Elon Musk can't be successful here in India. Those are the words coming in from Sajjan Jindal, chairman and MD of the JSW Group. Now, he's saying that Musk cannot produce what M&M and Tata Motors can do here in India. He's also said that to become successful in India is not an easy job. And all of this in conversation with our colleague Shireen. Shireen caught him at the sidelines of the EY Awards last evening. Take a look at this.
Everyone perhaps has watched President Trump's address to Congress this morning. It's the longest address in U.S. history at over 1 hour and 40 minutes. And there was plenty there in terms of trade, tariffs, and so on and so forth. You know, the Prime Minister speaking just 24 hours ago said, it is time for Indian industry not to play spectator. Indian industry needs to rise to the occasion, needs to take up the challenge, needs to go out there and become a part of global supply chains. As you look at what's happening around us in the world today, Mr. Jindal, do you see this as an opportunity or as a threat to India?
No, I think Prime Minister Modi has already talked about it, that this is our time. India's time, and we have to go out there and be the part of supply chain. And I completely agree with it. Trump will come and go. There will be this Trump or another Trump. This will continue to happen. So we have two opportunities in front of us. One is to build this nation, India, which by itself is a huge marketplace, and we don't have to fear anything. We have to build it. We have to really put our best foot to build this nation and build it well. And we are very fortunate that we are at this time, we are here to build this country, and we are really doing it. Second is that we can really be a part of the global supply chain. Indian companies are very good at it. We have an extremely good cost structure. We have a very good skilled manpower. And we are already we are a very good supply chain partner of the world industry. And we need to really expedite that, and we have to expand that. So I'm very clear and very confident that we can really do that.
You're confident that we can do that, but the lament of the government, and this is from the finance minister, more recently the chief economic advisor, once again saying the private sector is not doing its part, private capex is not picking up. Why, if you believe that all of these opportunities exist and this is the moment for India, why are we still not seeing private investment pick up?
I mean, So in bits and pieces, private investment is happening. I wouldn't say that private investment is not happening. If you were to look at what JSW is doing, we are really investing and investing like hell. So there are many groups which are investing, but across the board, I would say the investment, the numbers are not as much as it should be. But I think it's time that private sector.
Is it a confidence issue? Is it a capital issue?
It's more of a confidence issue. I don't think capital is there is any problem with the capital. There is enough money out there. Actually, money is really chasing good projects, good investments. So that's not a problem. It's the confidence issue.
You know, speaking of risk-taking ability, let me come to you and get all three of you to actually talk about this, because it's very different how you're all going about this. As you said, you're investing, in your words, the hell out of it at this point in time across different businesses, Mr. Jindal, including the latest foray into the electric mobility space. Now, you know, Should you go wide? Should you go deep at this point in time in an uncertain environment? You're throwing everything at the wind at this point in time, from cement to paint to sport to infrastructure and so on and so forth. Conglomerates at this point with an uncertain environment, do you believe that the risks are higher, or do you believe you've actually been able to diversify your risks by being a conglomerate?
So I think, we are at this moment in time, I'm repeating this sentence, we are here, right, in India. India as a country, I don't think there is any country in the world which provides the kind of platform that we have been provided with today. So I believe personally that anything that everybody, so many entrepreneurs are sitting here, you can pick up anything, and if you put your heart to it and do it passionately, honestly, you will be a successful guy. There's absolutely nobody can stop you from being successful. Anything. I mean, for example, we are not in the paint business, or I'm not in the auto business, but I'm 100% sure.
So you're hoping to get into the paint business?
Yeah. No, I'm saying I've invested in that, and I'm putting now my heart and soul in the auto business. And I'm 100% sure that it'll be a super successful. There's nothing can stop me from being successful.
Nothing can stop you.
Nothing can stop me from being successful. So I know Anish is here from Mahindra & Mahindra, but I know that it'll be a super success. Because this country needs a huge amount of autos, huge amount of good quality stuff.
It needs Elon Musk as well.
Elon Musk is not here. He is in the US.
But he's likely to come. He's likely to come if the duties are cut.
He can't be successful in this country.
Why not?
I can tell you.
Why not? Why can't Elon Musk be successful in this country?
Because we Indians are here. We are here. He cannot produce what Mahindra can do, what Tata can do. Not possible. He can do under Trump's shadow. He can do in the US. He's super smart. There's no question about it. He's maverick. He's super smart. He's doing this spacecraft and stuff like that. He's done amazing. So I have nothing. I don't want to take anything from him in the sense that he's too smart. But to be successful in India is not an easy job.
Let me pick up a debate that started in Mumbai by your peer and your colleagues. Mr. Uday Kotak started it off saying that, look, Indian entrepreneurs and the next generation specifically needs to get out there, work hard, and not get into running family offices too early on. It was followed up by Harsh Goenka saying exactly the same thing, that, look, we need the entrepreneurial spirit back. We need Indian entrepreneurs and the next generation to sweat it out, as opposed to speculating, trading, and running family offices. Sachin Jindal, do you believe that the next generation is happy running family offices as opposed to running businesses? And is this a problem?
So Uday is a very good friend, and we always spar on topics, yeah. And on this point, I agree with Uday that the next generation tends to use the money which the father has earned and invest rather than working himself, right? So when my son came back from Harvard, and he wanted to start a venture fund, and he picked up one company in Bangalore, and he said, I want to invest in this company which was making EV two-wheelers. And I told him, so I also said, okay, this is his first project. He wanted to, so he said that, Dad, why don't you come along with me? I said, okay, I'll come. Went to Bangalore, visited this factory, amazing plant, amazing product, and but then I came back to Bombay in the aircraft. Parth asked me, what do you think about it? I said, not at all a good idea, because I want you to work, I want you to make money, and not use my money, what I have earned over the years, and then multiply that. That's not my idea. So, and then he changed. And then later on, I think Pavan Munjal invested in that company. What we were to invest, Pavan invested in that company. And, but that's because he earned the money himself. So not his son did not invest. So, so therefore, I completely agree that the next generation, but to a point, Harsh Goenka's son is smarter than Harsh Goenka, right? And he's really doing an extremely good job. So to say that and Uday's son, Jay, is extremely smart. Yes. And he's now working in the bank and doing extremely well. So the next generation, most of them are extremely smart, smarter than us. My son is smarter than me. And most of our sons, our daughters are smarter than us. They have to be given the right direction by the parent. that you need to invest, you need to work hard, you need to build yourself and not use your father's money.
Oh, what a lovely, lovely exchange. That's Sajan Jindal agreeing with Uday Kotak, urging India Inc. to nurture that spirit of entrepreneurship in their next gen as well. Really lovely thoughts over there. We'll take a break on that note, come back on the other side. Manisha Gupta is going to join in with the latest from the commodity world.
You know, the market has turned and market has changed. So we were up strongly 100 points, then we were down 80 points, we are up 20 points now. So a fair bit of volatility is what you're seeing, but it's not staying down. That's the more important thing. And I don't think the market breadth faltered at all through the course of the day. This is what we've been saying. Well, the focus has been large caps and large caps, but broader markets for the last 3 days now, all of this week, has looked like it wants to bounce. And it indeed is bouncing. So 2% yesterday on mid and small caps. Today there is again 0.75% on mid caps, and the small cap index will come up on your screen as well. Actually, if anything, broader markets have become, at least the market breadth on my screen, 2,100 stocks are higher and 400 stocks are lower. So 5:1 in favor of advances, irrespective of whatever else is happening as far as Nifty is concerned. Mitesh is with us with what he'd want you to do in terms of indices. Is there a trade? And of course, stocks. Mitesh, your take an hour in.
Prashant, first thing, I think, we kind of topped around that 23,450, 500 mark. Fell off nearly 200 plus points from there. And I think that was a good entry point. So anything close to about 22,270, 250 is the buying zone right now, and 22,450, 500 remains the supply point. The directional bias on the hourly charts is positive, so I think I would still be, wanting to buy on that decline. And only below 22,200 would I be, worried again about the market. So one, I think it's been choppy, yes, to begin with, but as you rightly highlighted, the breadth was good, and the market direction to me on the hourly chart still remains positive. So again, because there's a significant supply at higher levels, I think anything 22,450, 22,500, that zone, once first we get close to that zone, I would advise profit booking. But on the stock side, we're trading with long bias. And after a long time, I think, I have two paint stocks as recommendations. So Asian Paints is a buy with a stop at 21.85 for targets of around 22.80. And Berger Paints also on the buy list. I think there's some crude effect playing over here, but the chart patterns are extremely good. So Berger Paints is a buy with a stop at 487 for targets of 510.
Okay, all right. Got that. Thanks very much, Mitesh, for that. Let's now go across to Manisha. She's joining in with a roundup of all the big headlines from the commodity universe. And Manisha, the biggest headline and the best headline for us is that Brent oil is below $70 a barrel. What's the latest?
Oh, well, yes, it's below 69 as well. And we did see prices fall below 68 at one point in time as well. So sharp declines coming in for the crude oil prices. Positive for the Indian markets and major importers for crude as well, for that matter. 2.5% of a cut is what we've seen in the overnight markets. And with that, we are trading very close to those 3-year lows. We've seen levels of 68.6 on the lower side for the Brent prices. And for the WTI, the US crude prices, we've seen prices slip below 66 as well. So if we see another 0.5% of decline, then we are very close to those 3-year lows coming in back yet again. So if you look at the damage on charts, that does look quite severe right now. 2.5% of decline in the overnight markets. And with that, we are down 5% in the last 1 week. And the last 2 years actually have been negative for the crude oil prices. 23 saw 11% of a decline, 24 saw 3% of a cut, and in this year until now we are down by 7% in case of crude oil prices. So after 2 years of decline, this is going to be a third straight year where we have started on a weaker note, and the way the matters or the factors are going, it does look like that this could be a weaker year for crude as well. Let me bring on those fundamentals for you then. To begin with, the US crude inventories have continued to rise, and we are looking at the US production hitting all-time highs in this year with an expectation that we would be looking at 13.6 million barrels per day of a production coming in from US. The second point is it's not just about the non-OPEC countries. The OPEC countries also are looking to increase production from the month of April. The Russian sanctions, if that go away, you could be looking at more oil coming into the markets. And the third point really comes in about tariffs there. If tariffs do come the way they are coming in right now on Canada and Mexico and China, and then retaliatory tariffs that we are looking at into the markets as well, US also will be charging 10% surcharge on energy when it comes from Canada. So all of this is bothering the markets. Slower economic growth, weaker oil demand is what is keeping the prices on the lower side. But this clearly is a story about two different worlds. On one side, you have the crude oil prices, which fell by 2.5%. On the other side, you have the copper prices, which gained up by 5.5%. In the overnight markets, we're trading at a 9-month highs in case of copper prices right now, where support comes in from the possibility that US could be looking at potential tariffs coming in for copper as well. This is after steel and aluminum already have seen tariffs there. Apart from that, China has been buying very strongly, and China yesterday also said that they will be buying into tangible commodities, is the reason you've seen many of these metals continue to gain up. So even as the US copper inventories have been declining, the LME and the Chinese copper inventories have been increasing. With the kind of gains that copper has seen, we are up by 7% in the last 1 month and up by 16% in this year until now.
All right. Thank you very much for that, Manisha. We'll take a quick commercial break here. We come back with our special segment. It's the economy. Latha in conversation with the top CRISIL team on their just released India Outlook report. DK Joshi and Mirain Lodha coming up on the other side.